us for today's webinar on special purpose acquisition companies, otherwise known as SPACs. Today's webinar will focus on the complexities, the risks, and the opportunities of SPACs and how they have grown to become so popular, as well as their benefits to investors and issuers. For those of us coming into contact with the concept of SPACs for the first time, it will suffice to say that SPACs are a way for investors and public companies to mitigate public market volatility and risks. SPACs are formed to raise capital in an IPO, that's an initial public offering, with the purpose of using proceeds to acquire one or more unspecified businesses or assets to be identified after the IPO. Please stay on to hear more about SPACs from our global experts who will delve deep into the unique instrument, which is SPACs, its applications and opportunities, and the opportunities it presents. Before I present an overview of the agenda for the session, I would like to cover a few housekeeping rules. To our speakers, please remember to keep your microphone muted throughout the session, except when you are invited to make a contribution. To our attendees, please remember to keep your microphone muted throughout the session. Well, to our attendees, actually, we invite your active participation throughout the session through the Q&A box. If you have any questions at any point in time, kindly type it in the Q&A box and our team will do their best to answer it or hold it for the appropriate Q&A session during this webinar. Today's session promises to be truly enlightening. The welcome address will be delivered by Divisional Head Listings Business, NGX, Mr. Olumide Bolumole. His welcome remarks will be followed by a goodwill message from Mr. Dayo Bison, the Executive Commissioner, Operations at Securities and Exchange Commission, who will be ably represented by Mr. Al Hassan Suleiman Sidi, the Head of Securities and Investment Services Department at SEC. This goodwill message will lead us into the first panel, which will be moderated by Mr. Funsha Kiri, the CEO of Stanbic IBTC Capital. The panel session themed Understanding SPACs, the life cycle of SPACs from inception through merger consummation, as well as a newly public operating company. Will have an array of local and international speakers, including David Penton, Managing Partner, Navigating Capital's SPACs Operations Group. That's a very big name. He'll give us more detail about his organization and so on. We will hear from Mr. Eric Idiahi, who's the partner and co-founder at Verot Capital. We will also hear from Eric Guichard, who will be addressing today as Mr. Eric V, who is the CEO of Orango Investment Corporation. Please do use the Q&A function to ask them any questions which you may want to ask during their Q&A session. They will address it during their dedicated Q&A session during this webinar. Our second panel will focus on the legal and regulatory considerations for SPACs. And this will be moderated by Iwande Shembore, who is a partner at Olaniwo Ajayi LP. The panel featured discussants, which I'll name as Oguche Oguda, the CEO of Pension Fund Operations, Pension Fund Operators Association of Nigeria, PENOP for short. We'll also hear from Suresh Akhil, who's the Business Development Manager at London Stock Exchange Group. And also we'll hear from Lisbeth Epo, the Head of Listings Analysis, Listings Regulation, NGX Regulation. At the end of the session, we will also hear from Mr. Olumide Bolumole, who will deliver the closing remarks and bring the session to a close. Without further ado, I would yield the floor to Mr. Bolumole to deliver the opening remarks and start the session. Over to you, Mr. Bolumole. Thank you.
Thank you so much, Toby. Distinguished ladies and gentlemen, on behalf of the board and management of the Nigerian Exchange Limited, NGX, it gives me great pleasure to welcome you all to this webinar on special purpose acquisition companies, or SPACs for short. And this webinar is themed around SPACs, as an alternative route to public markets. I would like to express my profound gratitude to the panelists, moderators, and participants for making time out of their busy schedules to attend this webinar. In recent times, SPACs have experienced a steady rise in popularity across global markets due to the increased need for investors to explore opportunities in the capital markets for diversifying investments and maximizing returns. At the exchange, as we work towards becoming the preferred African exchange hub, propelling innovation in a range of areas, the exchange has identified SPACs as a timely solution to prefer an alternative route to the increasing number of listings, whilst maximizing and protecting shareholder value. The purpose of this webinar is primarily to create awareness amongst capital market stakeholders and the investing community on the existence of this innovative investment vehicle, as well as arouse the appetite of credible sponsors. We believe that through this event, we can achieve this objective ahead of the launch of SPACs in the Nigerian capital market. Today's session will feature discussions centered on understanding SPACs, as well as highlighting necessary legal and regulatory considerations. We will focus on educating and addressing concerns relating to complexities, risks, and opportunities, how and why SPACs have grown in popularity, as well as their benefits to investors and sponsors. In 2020, 247 SPACs were created with $80 billion invested. And in just the first quarter of this year, a record $96 billion was raised from 295 newly formed SPACs. By comparison, just a decade earlier, only 2 SPACs came to market in 2010. The growth of SPACs in this period is further demonstrated in the United States, where SPACs accounted for 50% of all new publicly listed companies in 2020. The increased popularity of SPACs as a viable investment vehicle is attributable to the shift in global markets from traditional IPOs to unique alternative capital raising opportunities, offering benefits with SPACs offering benefits such as faster execution, potentially higher valuations, and access to operational expertise of sponsors and issuers. Our SPACs proposition provides key benefits to both the buy side and sponsors. For investors, SPACs as an investment vehicle offers involvement in the decision-making process for the selection of the target company and offers the ability to diversify into target or underrepresented sectors. For sponsors, SPACs presents the opportunity to enhance fundraising for an attractive investment venture while offering the opportunity to reduce the cost and time to market. With SPAC sponsors typically being experienced financial and industrial professionals, they are able to leverage their network to offer management expertise to create value for shareholders. For the target company, the product presents as an alternative route to accessing capital and attaining public listing. The NGX recognizes the opportunity for SPACs to support catalyzing economic growth through public markets in our nation, and indeed Africa. We see the potential of SPACs to diversify listings in our market and broaden investment opportunities for domestic and international investors. To that end, we have put this event together, and the exchange would also schedule a workshop hosted by the NGX X Academy to deepen knowledge in SPACs for qualified investors and sponsors. Distinguished ladies and gentlemen, I'm confident that the insightful deliberations of this webinar will provide clarity on the areas of uncertainties, explore opportunities, and increase awareness of the benefits of SPACs to the Nigerian capital market. NGX remains committed to the development of innovative capital market solutions to nurture and encourage new listings, while leveraging technology to optimize our processes, improve time to market, create alternate routes to market, and further deepen liquidity within the Nigerian capital markets. Once again, I welcome all our guests to this interactive session, and I encourage you to participate fully in the discussions. I wish you all fruitful deliberation. Thank you.
Thank you very much, Mr. Bolomole. Without further ado, I will now invite Mr. Al-Hassan Suleiman, CD, Head of Securities and Investment Services Department, Securities and Exchange Commission, to deliver the goodwill message on behalf of Mr. Dayo Bison, Executive Commissioner, Operations at SEC. Mr. Al Hassan.
Thank you, Olutobi, and good morning. Let me start by saying that on behalf of the Executive Commissioner of Operation, Mr. Bayo Obison, that we apologize for his inability to be here by himself. And this was due to an unavoidable reason, as he currently is in Ghana for another engagement, of which he would have wished to be part and parcel of this engagement. So on that note, please accept the apologies of the Executive Commissioner once more. So on his behalf, let me start by reading out his speech. Good morning, distinguished guests, ladies and gentlemen. It is my honor to speak at this important webinar organized by the NGX to discuss special purpose acquisition companies, SPACs, as an alternative route to public markets. Let me start by commending NGX for putting together this webinar, which seeks to highlight opportunities available to the market to access financing through SPACs at a time we need to deepen our market. A SPAC is essentially a non-operative or shell company whose securities are publicly traded. A SPAC has a limited lifespan and is formed with the sole purpose of effecting an acquisition, a merger, or a combination with a privately held business to enable it to go public. SPACs raise money largely from public equity investors and have the potential to de-risk and shorten the IPO process for their target companies, offering them better terms than a traditional IPO would. At the point of IPO, SPACs are required not to specify the company that they intend to acquire. However, they may indicate target sectors and industries. Following the IPO, the monies are kept to the custodian in the escrow until a suitable target company is found. Upon conclusion of the acquisition, the shareholders of the SPAC automatically become shareholders of the acquired company. Typical life cycle of a SPAC involves incorporation and IPO phase, target search, negotiation and acquisition stroke merger, also known as the SPAC. If no acquisition is made within 2 years, SPACs are typically liquidated and monies returned to the investors. Target companies are mostly startups that may have gone through venture capital and or private equity financing and are ready to go public. The SPAC acquires or merge with target company and in the process becomes a listed company. This gives them an alternative, albeit easier way of going public, unlike the traditional IPO that is subject to a greater scrutiny. Although SPACs have been around in various forms for decades, during the first 2 years, they have taken up in the United States. In 2019, 59 were created with a value of about $13 billion invested. In 2020, 247 were created with a value of about $80 billion invested. And in the first quarter alone of 2021, 295 were created with a value of $96 billion invested. In 2020, SPACs accounted for more than 50% of new public listed US companies. Investing in SPACs comes with attendant risk. Unlike in conventional IPO, where all the necessary information about a company is disclosed in the prospectus to enable investors making informed decisions, investors in SPAC IPO are making a leap of faith that is promoters will be successful in acquiring or merging with a suitable target company in the future. The reduced degree of oversight from regulators, coupled with the lack of disclosure from the typical SPAC, mean that retail investors run the risk of being saddled with the investment that could be massively overhyped or occasionally even fraudulent. The Securities and Exchange Commission is currently in the process of developing its rule on SPAC. As with every rules and regulation, it passes the commission is guided by the needs to ensure investors' protection by requiring adequate disclosure and safeguards. As is the tradition, the commission will expose the draft rules to the market for feedback. The commission's rules committee is also currently reviewing the NGX proposed rules on SPACs for clearance and approval. You will agree with me that the collaborative effort of all stakeholders is necessary to achieve an enabling framework that will not only support development of SPACs, but will also aid in growing and deepening the market, while ensuring that investors are properly protected. Looking at the level of presenters and discussants on this webinar, I'm confident that we are going to have robust and fruitful discussions and deliberation that will set the ball rolling. I will enjoin all participants to actively participate by making the session highly interactive. Thank you, and God bless.
Thank you, sir. Thank you, Mr. CD.
Thank you.
Thank you for your goodwill message.
Thank you. So this is the letter that the commissioner is sending to the foreign place.
Okay, thank you. We're grateful.
Yeah.
Thank you for taking our time, and we wish you fruitful deliberations in Ghana.
Thank you.
Okay, so without further ado, we would proceed to the next agenda item, which is our first panel session. The panel session will be facilitated by Mr. Funsho Akere, the CEO of Stanbic IBTC Capital. I'll just hand over to Mr. Akere. Funsho, please, you have the floor. Over to you.
Thank you, Toby. Good morning, all. I'm extremely optimistic about the future of the Nigerian capital markets, and you'd ask, why do I say so? When you listen to the opening remarks by the Nigerian Exchange, by Olumide of the Nigerian Exchange and Mr. CD of the SEC, you cannot but give kudos to our regulators for pulling a forum like this together. This is typically what an initiative you'd see driven by the private sector or capital market participants. Instead, we're seeing this pull coming from the regulators who are watching developments in the global capital market and seeing how they can accelerate the growth of the capital market. So I'm extremely excited, and we have to give thanks to our regulators. Why are we here? There is obviously a clear benefit to accessing the public capital markets or the public equity markets. Traditionally, most people have accessed the public equity markets via a listing, and that listing can come in two forms. The first form was, going to issue shares, so undertake an initial public offering, and off the back of that, do a listing. And we saw that, we saw lots of that in 2003 to 2008, where there was a wave of public offerings and listings, and we saw tremendous growth in the Nigerian equity capital markets. Post the global financial crisis, obviously there has been a dearth of listings. In the decade 2010 to 2020, there was probably one major public offering, which was Seplat. You had the emergence of direct listings globally, and we had MTN Nigeria being direct listed on the Nigerian exchange, and obviously there was a public offering by Airtel Africa. That's three major transactions in the space of a decade. So the third alternative to a listing is obviously a SPAC, and Olumide and Mr. CD have given some historical or some background information on SPACs. Olumide highlighted that in 2020 alone, there were well over, I have 248 in my notepad as the number of SPAC IPOs with over $100 billion of capital raised. This is 3 times and this is in the global capital markets, and which is 3 times as much as any year previously, and more proceeds than all previous year combined. So you can imagine the international capital markets going into COVID and worrying about transactions, and all of a sudden through innovation, market creativity, you were able to boost the capital markets via an issuance of 248 SPAC IPOs. Why is that relevant? Now, I talked about over $100 billion of capital raised. That $100 billion of capital can be deployed to, you can do a 1 to 5, so deploy to about $500 million of M&A activity. Because once you've raised the money as a SPAC vehicle, you have to then find a company to merge with, and that generates M&A activity. So you can imagine the impact that had on markets that were international markets in the US, market activity, revenue generated, tax revenue to the government, etc., from having over 600, or potentially $600 million of capital market activity in a year where there was, in a year where you had the worst pandemic in history. I think the first week of 2021, I seem to recall that there were over 10 SPAC IPOs, and obviously that market has continued. So I think that's why we're here today. We've assembled a group of experts or knowledgeable people to share their experiences. In terms of the structure of the panel, there's a presentation that will be made by David Penton. David and David would obviously introduce himself at the start of his presentation, but David works for Navigation Capital Partners, and he's managing director in charge of SPAC operations, and they've been involved in issuing multiple SPACs in the international capital markets. We've also got with us Eric, and I think for this purpose, we'll call him Eric V. So that's Eric Guicard. And Eric, has done quite a bit of work trying to see how one can pull together a SPAC that leverages African assets, and he will share his insights. And we've got, lastly, Eric Idiahi, who we'll call Eric. And Eric is co-founder of Verod Capital. And Verod has been, over the years, very active in the private equity space, raising capital, deploying capital, and one of the leading private equity firms in Nigeria, who would also share his insights. So just if David is on, I know David had some challenges connecting. If David is on, we can take David's presentation. Otherwise, I think he probably still has some challenges connecting. So maybe we can go into opening remarks, starting with Eric V. Eric, and if you can maybe just start off by introducing yourself before you give your opening remarks. Thanks.
Yes, no, absolutely. Thank you very much. I'd like to thank the NSC and the staff who've organized this very impressive platform. I believe maybe the first on the continent to talk about these advanced instruments, sophisticated instruments, and their benefits. I also would like to thank the Standard Bank for arranging for me to participate, albeit it is 4 o'clock in the morning, in the US. So I've been able to wake up early and do my exercise in order to remain sharp this morning. As Funcho said, my name is Eric Guichard. I'm the founding CEO of Orango Investment Corporation, which is a new $500 million private equity and transactions platform created by Paulo Gomez, who is the former World Bank board member representing 25 African countries at the World Bank, and also Mr. Austin Ometurua, former CEO of Citibank West Africa and Citibank North Africa. Our interest and motivation is to take advantage of the Africa Free Trade Agreement to identify companies both on opportunities both on the public side as well as the private side, and scaling them to take advantage of the new framework. In that vein, we've also looked at ways of normalizing African assets internationally in order to attract global capital, which is exponentially increasing. attract global capital into African markets, and we think that that SPACs basically represent a powerful instrument that could be leveraged by the various exchanges on the continent. With respect to our activities, we have been very busy in working and partnering with navigation partners to pipeline a number of opportunities that could be attractive to US-based investors, institutional high net worth family offices investors, particularly in the realm of asset classes that are globally understood, such as digital infrastructure, such as technology, and a few others. In that vein, we've put together a SPAC, which we are registering with the US SEC later this fall, called the Bayless Digital Africa Infrastructure SPAC, targeting to raise about $250 million. The idea there is to take advantage of the significant total addressable market that represents the digital wave on the continent. We hope that this is the first of several SPACs that we're going to be doing. Ultimately, we would like to create a mirroring effect between SPACs launched in the US and SPACs on the continent. That would require harmonizing the regulatory framework between the two markets, an issue which I'd be glad to discuss today as well. Thank you.
Thanks, David. I said David. Thanks, Eric. Yeah, I was just checking to see if David has joined us, but thanks, Eric. I think you touched on a couple of key points, which I think we would pick up in the course of the discussions. I'm glad that you talked about the regulatory piece, and we obviously have panel 2, where panelists will go through some of those regulatory considerations. So I guess when we get into some of the Q&A, some of the points you raise hopefully will be picked up and addressed in the next session.
Yeah.
Yeah, go on.
Yeah, if I think David is still having some challenges. Although I don't have the 2 slides that he was going to show, I could synopsize the key elements that he was going to talk about, particularly sharing navigation's experience in the SPAC market in the US and his view about how that experience could be instrumental in the early stages of setting up the SPAC framework in Nigeria. So if you don't mind, I can just go ahead and provide that information.
Yep, no, that's perfect. So I think please go ahead, and
Sure.
Then we will take Eric's opening remarks shortly after.
Sure. So David Penton, is a somewhat of a living legend here within the U.S. capital markets. He is originally from Jamaica. He is a Rhodes Scholar, where he did his MPhil. He's also a graduate of the Harvard Law School. He is the second president of the Harvard Law Review of a Black persuasion after obviously Barack Obama. He worked for Morgan Stanley for a few years, subsequently joined Goldman Sachs, and then decided to launch a private equity platform, which he did out of Atlanta. He sold that platform, I believe, to Goldman Sachs, subsequently acquired Mellon Ventures of Mellon Bank. And he, with a few of his partners from Goldman Sachs, have been doing SPACs since 2015. Since 2015, they've done between 15 and 16 SPACs in the US with various partners, including JP Morgan, Goldman Sachs, obviously, Bank of America, and Citi, who's the leading underwriter in the US. They've raised about $4.5 billion worth of capital. Very successful SPAC. They also advise the regulator, on public comments of proposed changes in regulation. In terms of the attractiveness of the SPAC instrument in the U.S., obviously a large part of the reason why SPACs that have been around since the mid to early 2000s. The large part of why they are so popular in the U.S. is because obviously of the the monetary context with significant injection of capital by the Federal Reserve. That money, which is estimated about $3 to $4 trillion, needs to find a home. And the SPAC, which is an accelerated way of bringing equity propositions to the public market, seems to have caught fire. But above and beyond, those external dynamics, the intrinsic structure of the SPACs also, commands quite an interesting review. First, the structure is very much, and I noted the point about investor protection, but the SPACs as structured in the U.S. are very much structured around the protection of the interest of a retail investor, who is the IPO investor, and then potentially the PIPE investor on the back end. One of the key features, for instance, is that the retail investor in the SPAC has the right to receive warrants, which gives them significant upside on the underlying entity that is being brought public. Number two, in the event that they don't like the target acquisition that the SPAC has decided to bring on board, they can vote against that target. And if the managers of the SPAC are unable to close a transaction within 18 to 24 months, they get their money back. And in addition to getting their money back at par, they maintain the ownership of the warrants. And so you can see from that standpoint that the investor protection in terms of principal risk is very much robustly protected. Recently, the SEC has made a few inquiries, the US SEC has made a few inquiries around the treatment of warrants, and I think have been making some rule changes so that warrants are treated more as liabilities of the sponsors as opposed to debt, which fueled significant incentives on that front. David's platform thinks that the SEC's involvement in trying to provide more transparency of the underlying companies, provide more truth in disclosures, provide more robustness to the instrument, and in fact underpin the longevity of the instrument as a fast track process of bringing private assets into the public market. Reverting back just to close, in terms of why this is important, in the African context, the fast track nature of the instrument, the investor protections as expressed in the US structure, and the ability of the instrument to tap into locked up liquidity, whether it's pension funds, insurance companies, treasuries of corporations. This is, a powerful instrument that provides significant benefits all around, and I think needs very special consideration by the NSC and the regulator as a way of, not only deepening the local capital markets, but also providing great diversity in asset class for institutional investors. Thank you.
Thanks, Eric. Thanks, Eric V. It's a unique panel. We've got two Erics on the panel. So I think you touched on, thanks. I think you gave a very good overview and really touched on, the key elements of issuing SPACs and even, life after issuance. So I'll come back to it, come back to you in a second. Let's move over to Eric and maybe get some opening remarks from Eric. I probably, given the time, it's probably 4 or 5 a.m. in the US. So maybe that's enough time for you to quickly grab a coffee, because we'd also like to see you participate on the next panel, or at least ask questions.
Sure, absolutely.
So Eric, over to you.
Thank you for the introduction, for sure. So my name is Eric Idiahi. I run a company called Verot Capital, a private equity firm with about $400 million under management, investing across West Africa. We've been doing this now for about 12 years, and always looking for ways to exit, of course, create exit opportunities The stock market, like you said in introduction, has not seen a lot of activities in terms of IPOs in the last few years. The US, we've looked at the US markets and other markets in the last couple of years and have seen this activities with SPACs. And then over the last year or so have actively been engaging in the Nigerian Stock Exchange for how to introduce these instruments into the capital markets in Nigeria. We think this would be a great opportunity to actually attract more capital into the Nigerian markets because it creates various avenues to list businesses and to bring businesses onto the market. Also, with the explosion of tech in the Nigerian markets, we see that SPACs are usually a good way to introduce new age companies or new economy companies into the stock market. So it's something we're quite excited about. It's something we've learned a lot about over the last year. We're not as knowledgeable as Eric V, but it's something we want to learn a lot more and see how we can work with the stock exchange, with a lot of our portfolio companies and a lot of our investee companies, and also participate in actually creating SPACs in these markets and promote them over time.
Thanks, Eric. Very useful point. I will probably give you an opportunity to ask Eric V a question after probably the first round of questions, because I like the fact that you've been, talking to the exchange about, using SPACs as an exit option. I think, it's in over 20 years of operating in this market, I just haven't seen a dearth of seeing the market with so little equity capital market activity. So if we can really get this SPAC IPOs up and running and really understand understand the risk factors and mitigate for the risk factors, understand what it takes to get institutional investors invested in backing a SPAC, because ultimately, from what Eric V said, it's almost like a convertible bond, right? With an option to back your investment into a potentially high growth company. So I think, Eric, I would maybe think about one or two questions you'd want to ask Eric V, which may help you in shaping your thinking. I'll move over to Eric, and probably my first question to Eric is, if you look at a SPAC, you can almost unpack it. There are the investors in the SPAC, there's the sponsor and the investors in the SPAC. And that's where really quite a bit of work gets done. Obviously, you've got the target companies, you have the regulator regulating the framework, and you have investment banks obviously in there, issuing the SPACs and helping out with the M&A. But I think institutional investors are key, because that's really the big unlock. And in the US markets, you've been able to unpack this and get the institutional investor community to back SPACs. So how would you suggest that institutional investors are sensitized about the attractiveness of SPACs as an investment asset class? You can focus on issues around risk mitigation, liquidity provision, return prospects relative to other available asset classes.
Absolutely. Thank you for that question. I think the way to think about the SPAC structure is to look at where are the entry points in terms of investment opportunity. So as you mentioned, there's the sponsors, the SPAC sponsors, and who they are, what their interest is, what is their commitment, and what are the potential returns. Then you have the IPO investors, and then there's a whole nomenclature around how that process works and what the rules are. Eric mentioned, the opportunity to exit. There are certain rules around, who can be a target and how does a target ultimately make it, into being the onboarded, entity, which I'll talk about. And then lastly, there's what's called the PIPE, so private investment in public equity, components, which comes into play, particularly when the sponsors and the management team are negotiating with the target on what the exact injection of capital capital is, and that's where the institutional investors can play a significant role. So let's just start with the first. The sponsors are essentially, bankers and or interested parties who have significant relationships, can bring to bear those relationships, both in terms of underwriting the SPAC, but as well in terms of investing in the IPO and also investing in the PIPE components. In exchange for that responsibility or that value adds, they have to put up some capital, which essentially covers the expenses of forming the SPAC, registering the SPAC, doing all the legal documentation, all the marketing, et cetera. On average in the US, the SPACs are, cost around between 7 and 10 million US dollars. Entities like Navigation have a very unique business model in that they will cover up to 80% of the cost of the SPAC. And then the 20% will then be distributed among those who are quote unquote helpers in making sure that the SPAC is a success. Just to note or to reemphasize, backing Navigation is Goldman Sachs, the bank, and so therefore a lot of the capital that's being put to work on behalf of Navigation and their partners is actually coming from Goldman Sachs. In exchange for both the capital, all the work, putting together the boards, et cetera, they receive a significant return. So in the first tranche of returns that the sponsors receive is about, if I'm not mistaken, 3.1 times the original money that they put in. And then subsequent to the IPO, they then also receive a minimum of about 3.7 times their original money. And if they negotiate well, they could also receive some warrants, which also gives them some upside on the back end. That aligns, their investment incentives with those of who are directly investing in the IPO and those who are investing in the PIPE. The second order of investors essentially is the public and institutional investors who are buying the IPO. Most SPAC IPOs in the US have priced at $10, some as high as 15 and above. But on average, SPACs have raised about $250 to $300 million, in some cases up to $500 million. The equilibrium price, if you will, is between 10 and 12. And then that's essentially where the public essentially is buying into the SPAC. Beyond that, as I mentioned, the management team has certain rules that it has to adhere to. One, they have to issue warrants to the investing public and institutional investors. Number two, they have, as I said before, between 18 and 24 months to find a target. In the preparation documents, they have to identify the universe of targets. We're not necessarily suggesting, either implicitly or explicitly, which target they are favoring, right? So that the rules are that up until the point the IPO actually occurs, no discussion about a very specific company is actually had. That is a red flag with respect to the SEC. And the point there is, you have to demonstrate that you have gone through extensive due diligence in identifying the best company for the SPAC, and then having triggered that process, it is open book for examination by the SEC, et cetera. That rule is extremely important, for transparency purposes, for good governance, et cetera. On the back of having identified a target, you have to then bring the proposition to the investors. The investors have to vote approval based on the arguments that you are making as the manager of the SPAC. If there is a majority, then that acquisition, gets closed. And even prior to that, to the extent that you've raised, say, $250 million, and that the target acquisition is at that price or below price, you need to justify the use of proceeds in that acquisition. If there is need for additional capital, that's when you then introduce private investment in public equity options to raise additional capital through that process. Again, the retail investors and institutional investors in the IPO who hold the warrants have the right to vote up or down at every single step until the actual close of the transaction. That essentially is, the entire scope and value added. For the sponsors, it is a huge opportunity, which is a reason why whenever you're discussing with distributors, be it private investors or even underwriters, you'll find that they will not get involved in the SPAC unless they have a piece of the sponsorship, because the returns are quite significant. In total, you're looking at about 6 to 6.7 times original money put up in the SPAC, which is mind-boggling. Again, keep in mind the time frame, right? So that's 6 times money, in a 24 to 72 month period. So your IRR would be something that could be quite quite attractive for any passive investor to participate as a sponsor in a well-structured SPAC. Now, just to close on this point, there've been some underperforming SPACs where post the acquisition, the target company has underperformed, or you've had some mischaracterization of the underlying performance of the company. Those have raised obviously yellow flags around whether SPACs and the process of acquiring companies need to be reviewed by the SEC. But ultimately, all these reviews by the regulator, strengthen the very important role that SPACs play in increasing the number of equity propositions in the market and giving investors, public investors, both institutional and retail, the opportunity to diversify their portfolio. Thank you.
Thanks, Eric V. Maybe just something to think about. I know that there probably would be a couple of potential sponsors in the room, or individuals who have considerable industry experience, operational experience, maybe even former bankers or bankers who are about to retire and thinking about pulling together a SPAC. So, I mean, after we get comments from Eric, I'd like to maybe if you can touch on what a potential sponsor should, how should they go about it? If I'm a potential sponsor, how should I go about thinking about pulling together a SPAC? So I would go on to Eric, and actually before I go to Eric, just a comment. I mean, there will obviously be institutional investors on the call, but it's maybe just to clarify. So if I'm an institutional investor, right, and trying to figure out, should I invest in a SPAC? What you're effectively saying is that all they're doing is putting money in escrow and earning, returns, risk-free returns, or perhaps even slightly better than risk-free returns. And the investor has the option, when there is a deal, to elect in participating in the deal, right? And ordinarily, if a company was going to go public, there would be an IPO discount. So if a company is trying to go public via a SPAC, you would imagine that there's a discount that's embedded actually in the valuation at which they would merge with the SPAC. So as an institutional investor, you are then looking at a deal the same way you'll be looking at a fresh IPO by a company, but you have the option to elect to participate on the deal or to take your risk-free returns and get off the table. Is that correct?
That is absolutely correct. That is spot on. Yes.
Fantastic. All right, over to you, Eric. You are the most important person in the room because, listening to Eric V, you can participate as a PIPE, right? i.e., private equity investment in a public deal. You potentially can be a sponsor, giving your wealth of experience in private equity. And also you can actually bring your portfolio companies as potential targets for SPACs. So I mean, maybe just to ask you, what will it take for you to perhaps, proceed with setting up a SPAC? And then perhaps any other thoughts on any of the things that, Eric V has mentioned?
So we've actually looked at all three perspectives. It's something we've done a lot of work on over the last year or so. And yeah, investing in potential SPACs, but our mandate is really to invest in this market, in this region, in Africa. But of course, there's not been a SPAC yet in the Nigerian market or anywhere in the West African region. So we definitely hope to be involved in the first one that comes to this region. Something that we're fingers crossed will be a part of, either investing in one or actually even setting up one, because as a private equity company, of course, we raise money and invest in different things. So we've also explored the opportunities of actually setting up a SPAC, sponsoring one, and looking for opportunities to invest in. So it's something that we've also explored, and something we'd also like to see how we can work on for this market. And thirdly, as for our own portfolio companies also, it's something that we're in process of exploring doing a SPAC for a business in West Africa, but doing a SPAC offshore, or having it sparked offshore, where we list it with an offshore entity through a SPAC. So those three methods are things that we're very eager to be part of once the stock exchange here, or NGX, is able to have one live. But also, I think we'll probably be one of the first people to do one with a company in West Africa, offshore. We've looked at exchanges that would give us that ability to do so. The Netherlands is one, something we look at that market quite a bit, and also the US markets. So those are opportunities that we think are very ripe, and the sooner we can start participating in this, which from the West African perspective, that would be a great opportunity to create liquidity in this market. And we can see that. I think one of the exciting things in this market, like I said earlier, is the new economy, things having to do with tech, etc. So we can see a lot of linkages to those opportunities in creating really large liquidity events, opportunities for liquidity, or list companies like that on the exchange.
Thanks, Eric. I would give you an opportunity to ask Eric V a question, and I would, maybe just add an additional question to that, and then I will give Eric V an opportunity to ask you a question, and then we can close and take some of the questions from the audience.
I have 100 questions for Eric V, but maybe we'll take that offline. Okay. But I know he mentioned they're looking at opportunity to create a SPAC for companies in this market. What are the easiest companies you think local companies in this region, in Africa, Nigeria, West Africa, do you think you can actually SPAC or in the US? I know you're focused on the US markets, which is probably where most of the SPACs are, but of course the opportunities in Europe too. But I'll say, what class of companies or what types of companies do you think would be the easiest to partake in that opportunity?
Yeah, that's and Eric V, just while you respond to that, if you can also maybe just after you're done, maybe just suggest what role you think the NSC could play to facilitate the harmonization of SPAC regulations. You talked a bit about it, so that we can see a channeling of global capital to the local markets.
Absolutely. Thanks for that, Funsho. So, Eric, to answer your question, one of the biggest challenges is what we call a barbell. On the one hand, you have significant liquidity in the U.S. looking for high yield in a low yield environment, and then you have on the continent a lot of liquidity that's locked up for a number of reasons. Some of them pretty archaic when it comes to risk diversification. And the question is, how do you bridge the gap between those two? So our mandate at Orango is, as I mentioned before, to normalize African assets to attract global liquidity, particularly out of the U.S. into African assets. That requires a significant amount, sadly, of education, but also a way of comparing African assets to assets that are already being invested in those markets. So, for instance, there have been African targeted SPACs that have done pretty well. One in the consumer space, and then another one in the mining space out of South Africa that have done relatively well. Our view is that the way to drive more capital being invested is to look at asset classes that are deemed to be not necessarily intrinsically African, but that are deemed to have significant a significant total addressable market. And when you think, through that lens, there are a few industries that come to mind. Clearly, one obviously is the fintech space, still related to technology, but linking financial services in the context of a growing middle class and a growing need for financial services for households. Number two, would be anything around data. So data centers, mobile money, e-commerce, payment systems, etc. The 4 or 5 unicorns that have been valued at $1 billion or so in the Nigerian markets are indications of where attractive asset classes are deemed to be good targets for global capital, at least beginning there. And as those assets prove themselves, then you can look at potentially bringing in other assets. The driving force behind SPACs and other global capital allocation is the total addressable markets, right? So if the total addressable market is significant, in excess of $1 billion, you immediately attract the attention of global investors, particularly in the US. And if the asset class is something that has a mirror replica in the US, be it digital assets, e-commerce, financial services, et cetera, that becomes very easy to bridge that gap of understanding between the movers of capital in those markets and the assets available on the continent. With respect to other markets, I know that the London Stock Exchange may be driven by the fallout of Brexit, is very, very aggressive in trying to attract its own pipeline of SPACs. They've amended their rules to make it a lot easier to onboard SPACs at the LSE. I'm not quite sure where the Europeans are on that front. I think Luxembourg and a few other exchanges are looking at it, but given the shallowness of their market, it's unlikely that they would be major players. With respect to how do you facilitate on the regulatory side? I think harmonization is everything. I think I would recommend that the regulator, and I'm sure this already exists, but the back channel with the SEC and the SPAC team there to look at how they're looking at SPACs, how they're looking to regulate SPACs, how they are expressing in the investor protection, in the rules, disclosure rules, et cetera. I think that template should certainly be used by the regulators in Nigeria, because harmonization makes it easy for a portfolio investor in the US to say, oh wow, it's the same rules that we have in Nigeria. So yeah, I mean, a telecom or a data center or et cetera that is listed on that exchange is certainly a target for for acquisition for us, and therefore providing us with geographical diversification at the very least. So harmonization among exchanges, among regulators is extremely important to drive global liquidity.
Thank you for that. Funshaw. I think we're missing the moderator.
Yes, I think it would look like a moderator may have been bumped off the call. Our moderator might be bumped off the call. So what I can do is step in here and take 1 or 2 questions from the audience, if that's okay, to the 2 Erics.
Yeah, there are a few questions in the chat that that we can see.
Yes, yes. I think I'll take the very first question from Chinazom Izuora. He or she has asked, please clarify how SPACs differ from SPVs and not special purpose vehicles. Is it just the nomenclature, or there's a difference in the dynamics? Perhaps I could direct that at Eric V.
Yeah, sure. Excellent question. They're very, very different. SPVs are standalone offshore vehicles that are used as a means of separating or addressing commingling of assets. They're not, similar to SPACs. SPACs are a regulated entity. There are there's a special nomenclature for SPACs and how SPACs should conduct itself. Access to retail investors is almost assured in the SPAC space because it's a listed vehicle, whereas in SPV, as I said, is a private structure that is set up to achieve very specific objectives for the sponsor. So they're two different animals.
Super, super. We have Funcho back on the call now. Mr. Akere, would you like to take over if you're back with us now?
Yes, I am. Just give me a second. Lost connection. Yes, I know. I mean, time is fast spent, so we're probably moving into closing remarks so that we can give some time for Q&A.
Okay, that's super. So while you got bumped off the call, I had actually taken one question from the audience. So perhaps you might want to take another question, and then at the end of your Q&A, you can then do, if that works for you.
Sure, that's fine. I would maybe just allow you to take the second question while I, get my, quickly go through the question Q&A box. So why don't you take the second question?
Super. I'll go right to a question from, actually, this just came in, and I think it's best if we direct it at Mr. Eric Idiahi. The question is directed, it has an interplay between SPACs and PE investments, which perhaps is the reason why I think we should direct it at you. So the question says, you briefly mentioned the idea of using SPACs to exit PE investments. I want to note that PE funds have always had exit issues, and it seems to have heightened in recent times. It would be good news to know why exits have become difficult for PE firms. And I think the more likely question, or perhaps the more targeted question for the SPACs conversation is, won't it be to our detriment if SPACs are used to exit such perhaps PE investments? I don't know if you got the question, Mr. Eric Idiahi.
Let me give it a shot. One of the issues why exit has been difficult in the last couple of years. I mean, at Verad, we've been quite, I guess, innovative in exiting deals. Actually, we're going to announce about two or three exits by the end of this quarter. But big issue is liquidity in the markets. There's just not enough liquidity in the markets. Public markets have been dried, like Funcho said earlier on. What a SPAC does is just creates that liquidity in the public markets. It creates those avenues to exit transactions or for companies to come and buy existing companies that they might like. But also, exits also is a function of the deals you do. I think Eric V was very specific on the types of deals that attract SPACs, just globally and potentially locally. So we think just doing the right deals with SPACs in the market, we think we can actually see a lot of potential exit opportunities with that, because it creates a lot more liquidity in the markets.
Okay. Just for
Thanks, Eric.
Okay.
Just before I think maybe just to add a quick point to that, Eric's point is extremely important, and I think that what we're doing today may potentially be an inflection point for the capital markets, because if we can get the right regulation and get institutional investors comfortable with investing in SPACs, the ripple effect is tremendous. Would almost be, I mean, I still remember back in 2002, where you struggled to raise $20 million. And at the height of 2008 or 7, you were raising over $1 billion in public offers. I still remember when there was no bond or CP market. And today you're raising, close to well over $1 billion in bond and CP issuances. So we can look back, if we all work together to create that framework, we can next year we potentially can see a market that's really up and running. Yeah, so I just thought to add that point, but go on to your question. I cannot see the previous questions because I lost my connection. So I'll let you run through. You're on mute.
Thank you. I wanted to write on the back of that question that Eric had just responded to, in line of exits and SPACs. Since IPOs often tend to be depending on who the investment party is, or IPOs could also serve as exits for some investors. Someone has asked, actually, just to get the question, Babatunde Olaoye has asked, what are the difference between traditional IPOs and SPACs? Perhaps Eric V can take that question. If that's okay.
Yeah,
correct.
Yeah, sure. So just quickly on this one, the SPAC instrument was created as a means of facilitating the access to the public markets of very attractive, medium-sized companies that may struggle with a traditional, IPO. The traditional IPO process is very lengthy, very expensive. The disclosure process, the documentation preparation, the regulatory review, could take as long as 18 months, alone before you actually get the approval to go to market. The SPAC instrument is made to accelerate. The trust is placed in the SPAC sponsors to achieve a list of key protection criteria that they vouch to the SEC to implement in selecting the target clients, and that trust or so placed by the regulator in the SPAC sponsors allows the fast tracking of these companies into the public market. But it's an instrument made explicitly to facilitate, to fast track attractive companies to the public market.
Yes, thanks, Eric. And if you think about a SPAC as one of three routes to becoming listed, with the other two being a direct listing and an IPO, if you're a private equity firm like Eric, and you're trying to exit, Eric has to weigh the options. I mean, at every point in time, each of those routes may have its benefits, right? And it's just ensuring that there's an alternative that, that's available to Eric that can generate capital market activity. There's a question, conscious that we're running out of time, there's a question about, are SPACs going to be regulated by the NGX and/or SEC, which I think we can take in the next panel, if that's fine with you, Dika. And there's a question about where capital will come from if the PFAs are not investing in equity, from Dave. And that's an important question, because one of the things that we would like to do is sensitize the institutional investor community. Actually, investing in SPACs, you're almost investing in a convertible bond. So actually, you could invest in the SPAC and then there's no reason why, or it kind of offers you a guaranteed return with an equity upside. So if you back a sponsor, for example, you're putting capital in, and even though PFAs are not investing in equity, it doesn't stop them from investing in a SPAC, because they will earn debt-like returns. And you could even have it such that the SPAC can only put the cash in investment-grade securities. So there are ways to de-risk it for PFAs or institutional investors, such that it almost becomes, I've invested in a debt convertible instrument, and before I convert, I need to appraise it and see if this is an IPO I would like to participate in. Yeah. So maybe we go to closing remarks, and Eric V and Eric I, you can, maybe if there are any questions you want to cover in your closing remarks, you can take them.
Yeah, I'd like to address a very important question that Dave Udwanu raised, and that is whether Eric can set up a SPAC just to exit his own portfolio. Depending on what the rules are in Nigeria, if there is harmonization, if there's a replica of the US-based rules, then the answer to that is no, right? So the main purpose of having a diversified universe of targets is to avoid, these potential conflicts of interest where, you're simply setting up this vehicle to exit your own, own transactions. On the other hand, it's not inconceivable for Eric's PE firm, to be talking to a SPAC sponsor about offering up some of his, majority controlled companies into the universe, into a broad universe of companies that are being targeted. In that sense, the arm's length requirement is respected, and if Eric's portfolio is lucky that one of their companies gets to be the target, then he's able to to exit that company. But the main point here is that introducing SPACs as an exit instrument is clearly important in the markets, right? Because without it, then there would be one less option that Eric would have, to offer up his, his company. Just one line, in closing, I think that the NSC and the regulators, I highly encourage that they look at SPACs, as an instrument to provide more liquidity, more risk diversification, more investment return for both institutional and retail investors. I also highly recommend that they connect with the NYSE and the US SEC, to compare notes on a key regulatory framework with the target of harmonizing the two, because that will, as I said prior, facilitate significant global flows into the NSE targeting Nigerian companies. Thank you.
Thanks, Eric B. Eric, over to you.
Yeah, and also, going to one of Dave's comments again. Yes, 100% with Eric V's comments in that we can't sponsor SPACs to buy our own companies, but we can sponsor SPACs as PE companies to acquire other companies. I think one of the trends right now in the US is that you see a lot of PE firms in the US, from TPG to Blackstone, actually setting up SPACs to go after several companies. So it's something that for this market, it'd be quite exciting for PE firms like ourselves to actually go and sponsor SPACs to buy third-party companies that are not currently in our portfolio, or target interesting companies that we feel can be publicly traded. So that's something that we're quite looking forward to. And I think it's something that can help jumpstart this market in Nigeria in terms of liquidity in the markets.
Fantastic. Look, very good discussion. Obviously, 1 hour is not enough time to cover all the key points, but at least I hope that this has given everyone or the audience an insight into what potentially could be a very active market. And we have to, I guess all parties have to work together to ensure that, we create a framework that, 1, mitigates the risk, but 2, ensures that there is significant capital flow, both from your domestic institutional investors as well as international investors into the SPAC product. The last thing I would like to say is that, also customization the flexibility is important, and I use the direct listing example. In the US, the regulators saw lots of people trying to do direct listings and eventually tweaked it such that you could actually raise primary capital in addition to doing a direct listing, because that was what was being asked by the investor community. So I think I would round up I would drop anchor at this point. Thanks all for active participation. Thanks to the panelists for a very robust discussion, and obviously the Nigeria Exchange for pulling this together and with support from the SEC. We'll move over to the next panel now and look forward to continuing the conversations on that panel. Thank you.
Thank you very much, Funsho. Thank you, Eric V. Thank you, Eric I. Very insightful conversation. Thank you as well, our audience, for your questions and your active participation. We will jump right into the next panel session. We want you to keep asking questions. Thank you for the questions that you've asked as well that relates to regulatory elements that will drive SPACs, which we will address in the next panel session. Without further ado, I would invite Iwande Sembore, who's partner at Olaniwo Ajayi LP, to lead us into the next panel session. Over to you, Iwande.
Thank you very much, Olutobi, and good morning, everyone. I guess without any doubt, we have had quite an insightful session with the first panel. And a few nuggets have been left with us, which will foreground our conversation in this second panel. I think the starting point is just to highlight some of the key objectives of SPACs as had been enumerated by the two Erics in the first panel. And I think the key one that really connects with the conversation we will be having on the second panel is the fact that it allows for diversification in the asset classes available to investors, particularly institutional investors, and also allows for the unlocking of capital for businesses in Nigeria. Without any doubt, the Nigerian exchange definitely has put together this webinar at a very timely point in time, knowing fully well that, as Funsho mentioned, there has been a dearth of primary listings on the Nigerian exchange. And so this is quite timely for everyone. Another point to note is that harmonization was one key point that was highlighted, and I think that we will be touching on that as part of our conversation this afternoon. Just to step back a little and give a little bit of background. Currently in Nigeria, there are no formal rules for SPACs as yet. But of course, the Nigerian Exchange Limited, in its proactive manner, has published exposure drafts of rules, which we'll be looking at this morning as part of our conversation. And of course, we will be juxtaposing that with other regulatory provisions and statutes that may impact the activities of SPACs in Nigeria. Today, if a company wants to set up and list for the purpose of acquiring interest in target companies, you would have to go the full hog of the typical IPO route. But with the draft rules of the NGX, we believe that this will change. And of course, Mr. CD, in his opening remarks, did mention that the SEC is also putting together rules, and I'll be taking him on this morning to ask and get some insight into what the SEC is putting together so that we can have some sneak peek of that also. So joining me this morning to discuss these issues are Elizabeth Ekpo, who is the head listing analysis at the NGX Regulations Limited, which is the independent regulatory arm of the NGX Group. In that capacity, she oversees the listing analysis unit and provides assurance on the integrity of end-to-end appraisal process for all listings within the Nigerian exchange. Also with me is Mr. Suresh Akil, who is a business development manager in the investment funds team at the London Stock Exchange. He brings to bear the knowledge of the London Stock Exchange and will be sharing with us his ideas and of course insights from the UK listing rules in relation to SPACs, which we'll be comparing with the Nigerian regulatory framework and also see learnings that we can pick from there. I also have with me Mr. Oguche Aguda, who is the Chief Executive Officer of the Pension Fund Operators Association of Nigeria, PENOC for short, where he leads the efforts of the 28 billion Nigerian pension industry, a key player, of course, in the Nigerian capital market. And of course, we'll be asking him some critical questions and getting his insights into how this new product can unlock the capital that the PENOP as a group has in its portfolio. So to kickstart this conversation, I will be calling on Elizabeth Ekpo to give us a broad insight of the draft rules of the NGX in relation to SPACs, and just highlighting salient provisions, bearing in mind some of the key points that have been made by the first panel in relation to what participants, sponsors, as well as investors would like to know in relation to that. Thank you.
Thank you so much, Yewande. Good morning, everyone. It gives me great pleasure to be here today to participate in this insightful conversation. And has already been noted, the Nigerian Exchange Limited, one of the things it tries to do is to continue to increase investment opportunities for investors and also for issuers to access capital. And so in light of this, and also to facilitate the development of SPACs in the Nigerian market, the NGX, in collaboration with NGX RegCo, which is the independent regulatory arm of the Nigerian Exchange Group that provides regulatory services to NGX, started putting together proposed draft rules as a regulatory framework that will guide the listing of SPACs on the NGX. And these rules are hinged on basic principles such as investor protection, enhanced market integrity, and adequate disclosure so that investors can make informed decisions when deciding to invest in SPACs. Broadly, the rules speak to certain requirements that SPACs have to adhere to as part of the way of raising capital and listing on the NGX. Some of the requirements will include requiring that SPACs as entities ensure that SPACs as entities ensure the size, this minimum size of funds that can be raised by SPACs. And this is mirroring the minimum requirements with respect to the board that the SPAC will be looking to list. As you're aware, we have about 3 boards on NGX, the premium board, the main board, and the good board. So for a SPAC that is looking to list, say, on the premium board, be required to raise at least 200 billion naira of capital. On the main board, that will be at least 4 billion, and on the standard board, standard segments of the good board, that will be about 500 million. There's also a restriction on the kind of investors that can invest in the SPAC, and the rules has restricted this investment to only qualified investors, which are institutional investors and high net worth investors, because of the complexity and the high risk nature of SPACs. So, and also the funds that are raised by SPACs are expected, at least 90% of them are expected to be ring-fenced and put in an escrow account, which can only be used to acquire viable assets or target companies, as the case may be, or return back to shareholders where there's a liquidation distribution. There's also the requirements on the kind of investments that the SPACs can invest this money until a time where they're able to either make this acquisition or distribute this money back to the investors. We also make provision in the draft rules to protect shareholders to the extent, just as Eric V has mentioned, where shareholders have the opportunity to vote against or for any viable assets or targets that the SPAC is looking to acquire. And shareholders who vote against such acquisition have the option to trigger their redemptive rights, where they can then take back their money from the shares that they have invested in the SPACs. There's also a time frame, just similar to what Eric B has said, by the rules of the NGX, that has a 24-month period for which SPACs must acquire a viable asset, and they are able to extend this subject to shareholders' approval of about 12 months. And when no acquisition has happened within that time frame, within 3 months, the SPAC is expected to trigger liquidation distribution and return money back to investors. There's also that Eric also mentioned something about conflict of interest, which is something that is very inherent in the structure of SPACs. And one of the ways that protect that is ensuring that directors who directors in the SPAC and who have interest in the target companies that they are looking to acquire, those directors abstain from voting during the board meetings where such target acquisitions will be discussed. And then also there's the rule speaks to minimum disclosure requirements that the SPAC has to make to investors, just to give investors some form of comfort and ensure that investors have adequate information to make a decision. So those disclosures will look to the prospectus. So the prospectus is required to be approved by the SEC. And of course, the prospectus will comply with what the SEC regulation says, the ISA. And also the fact on the terms of the founding sponsors, the shareholding of the founding sponsor, whatever the terms of those arrangements are, must be clearly stated in the prospectus so that investors are aware of what those terms and what those rights are. If there's any restriction or limitation to the redemptive rights of shareholders, those terms must also be clearly stated. The geographical area or the entire sector of interest of the SPAC in which we likely want to invest in is expected to also be stated in the prospectus, without, as Eric V has said, without necessarily giving an inclination of the particular company that the SPAC is targeting. And also, SPACs are not expected to have entered into any oral or binding commitment prior to the IPO which they are undertaking. So these are just some of the highlights that I would like to mention that are in the draft rule that have been exposed to the market, just to ensure that investors, again, are protected, ensure that it enhances market integrity, and that there's adequate disclosure to investors. And of course, in terms of continuing obligations, the SPACs are required, after being listed, to continue to make some certain reports to the market on their activities, their acquisition targets, and their statements of affairs up to the time when acquisition is being made. And of course, in terms of, just to add, like you mentioned, the FCCPC, of course, when the merger is contemplated.
Elizabeth, before you go on to talk about that, because I do have a follow-on question in relation to that, just before you mentioned the FCCPC, because that's very important. In relation to the timelines, you do have in the draft rules the prescription for a transaction to be completed within 24 months. But you have also highlighted the fact that the transaction documents have to go through the SEC approval. And of course, you're about to touch on the FCCPC, because under Nigerian laws, acquisition of majority interest will also be subject to the regulatory oversight of the FCCPC. And there's a timeline within which these approvals come through, and all of this may eat into the timing for a transaction to be closed. What is the protocol that you have embedded in the rules, or what is the plan for ensuring that there is synergy amongst the various regulators, as well as the various draft rules that would impact the activities of a SPAC in this regard?
Thank you, Yewande, for that question. I must mention that if you look through the website of the FCCPC and all the guidelines that they have brought out, there's extensive and clear requirements for which issuers that contemplating mergers are supposed to abide by, and ensure that their transactions are either there's a post notification if it's a small merger, or a merger review if it's a large merger. And so one of the things we always will encourage is that conversations start on time with the FCCPC. Of course, the FCCPC also has timelines for which it will respond to those inquiries. So issuers have to take into consideration those timelines to ensure that they are able to meet those timelines earlier. And the FCCPC also encourages, early pre-notification consultations for where their clarification will be provided to ensure that these timelines are met, or the adequate documentation is provided to ensure an efficient process for which these approvals will be gotten. But in any case, we are collaborative in our regulations, and we will always collaborate with issuers where there is need to engage the FCCPC as required.
That's very useful. Thank you very much. I mean, clearly, this is just a tip of what is to come. There definitely has to be ongoing conversations between all the regulators, because we need to bear in mind the key points that Eric highlighted, which is the fast track approach to markets, which is the key attraction for SPACs. And if that's taken away, then that already means that it becomes less attractive for sponsors. So Akil, you work with the London Stock Exchange, and of course, in about I think August 2021, there were certain changes that were made to the SPACs listing rules. Could you share with us some highlights of those changes, what necessitated the changes, and also listening to Elizabeth and the provisions, of the Nigerian exchange draft rules? Are there areas that you feel maybe we could take some learnings from the new rules in the UK or the European market generally?
Great, thank you, Yewande, and thank you to the NGX for allowing me to speak here today. It's been very interesting so far to hear all the views. So SPACs in the UK have been around for quite a while. However, the market structure and practice of SPACs in the UK have differed from other markets. So, for example, there hasn't been a shareholder vote upon acquisition. There hasn't typically been a redemption option offered to shareholders, and also the key kind of sticking point for sponsors and investors was that at the point a SPAC announced its acquisition, the SPAC itself would get suspended. So that meant that investors weren't able to trade in or out of the SPAC until there was sufficiently public information available on the target business. So this made it quite a challenging environment and unattractive for some sponsors to launch SPACs in the UK. So in response to that, and the global demand for SPACs, the FCA, which is the regulator, has proposed and has enacted certain rules, which, as you mentioned, Yewande, came into effect in August of this year, to make it a more a palpable environment for SPACs to list on the UK market, and it's a combination of having strong investor protection measures, as well as having flexibility in terms of being able to structure SPACs. In terms of what Elizabeth mentioned, and how the UK rules relate to that, I think common themes. For example, having a time limit for the acquisition. So within the rules in the UK now, it's a 24-month time limit for acquisition, and then it can be extended by 1 year for shareholder approval. There's also a 6-month extension possible if you're in the middle of an acquisition and there's just a few further steps to undertake from the sponsor side. There's also a requirement to have shareholder approval and also board approval for the acquisition. Capital has to be ring-fenced, whereas previously that was not a requirement. Now there's also a minimum capital raise requirement of £100 million. Now that has to be excluding sponsor capital, so it's only defined as from public shareholders, so that the sponsors can't be contributing to that 100 million in order to meet that requirement. Similar to what Elizabeth noted, the conflict of interest is also quite a big concern. So there, any directors which have relationships with the target would also have to, step away, and also step away from voting, I should say. And also there has to be a fair and reasonable statement published, and there has to be sufficient disclosures published on the target as well. So it's quite similar in terms of what the NGX is proposing, and it's also in line with other jurisdictions as well, in terms of bringing in the shareholder protections, the key ones being the shareholder vote, the redemption option, and also enabling an environment where the SPAC doesn't get suspended after it announces the acquisition, which was a key sticking point for sponsors previously listing SPACs in the UK. So yeah, those are a summary of the key changes in the UK context.
Thank you very much. It does appear that NGX rules were more or less, already proactive and took into consideration some of the shortcomings of the regional listing rules in the UK, and sidestepped that and went ahead to make sure they covered all the bases with the provisions that they have, and hopefully that will be passed on to formal rules that can be adopted. So before I come to Oguchi, I'd like Eric V to give us some insights in relation to the US market and the regulatory framework, if there are any learnings other than what have been highlighted. I think in speaking to Penton, I know that one of the questions we took on the first panel was about the reservation or the lack of investment by the pension fund administrators in the equity market. So we'll be speaking to Oguchi about that to understand what their concerns are. But just to hear from you, Eric V, if there are any insights you'd like to share with us in relation to the US market and the regulatory framework. Haven't heard the layout of the draft rules for Nigeria.
No, thank you for that. Absolutely. Just a disclaimer. I'm not a regulator, nor am I an advisor to a regulator. But a few things. I mean, the changes that Suresh has mentioned really highlights the need to link up the rules and the parameters to the objectives of the investors, right? So crafting rules that are independent of that input, creates a dichotomy that doesn't drive liquidity, doesn't drive the success of the instrument, doesn't actually achieve the ultimate objective of deepening capital markets, providing liquidity, and achieving risk mitigation and return objectives of market participants. I think that, to me, is the biggest learning. Even within the SEC, the consultation with the private sector is dynamic. Right, the SEC creates rules. It makes it releases it for public comment. Public comment is quite extensive. The market players, lawyers, portfolio managers, sponsors, etc., have extensive comments to make, to those rule changes. And at the end, the SEC weighs the pros and cons of all the comments and ultimately adopts the rules. The rules themselves, after they are adopted, are also subject to to comment, etc. That interplay, that interaction is extremely important in order to create a viable proposition in the market, and that applies to the SPACs. Thank you.
Thank you very much. And just to say that that practice has been adopted by the Nigerian Securities and Exchange Commission, as well as the Nigerian Exchange Limited, in relation to their rules. And that allows for insight and input from the private sector and practitioners, to give their views, and of course, for them to then take on a robust input from market participants before finally, approving and formalizing the rules. So that, and I think this will continue, particularly for this sort of new product. It's very essential that the likes of Eric Idiahi and all the other players within the sector, the tech startups also who will be affected, who would want to take advantage of these new rules, should also be allowed to contribute their suggestions in terms of putting together a framework that works. So on to Oguche, who is also a key stakeholder in this regard. We've heard a lot of, things said about investor protection, the rules, how there's disclosure, transparency, ensuring that, the funds are secured by an escrow arrangement and the opportunity to back out of the investment if the target asset is not one that you want to participate in. So coming back to you as the person who is at the helm of affairs at Penton, which sits on over $28 billion of capital, which is available for investment, and we are looking to unlock this capital. Are there areas where you think that the rules don't adequately provide comfort for you, or are there specific things you'd like the rules to touch on to ensure that yourself, as well as your colleagues in the pension industry, are able to take advantage of this opportunity when the SPACs rules are finally released and then transactions are coming on stream?
Yeah, thank you, Yewande. I mean, I always like to say that most people use one brush to paint the whole industry, and there are about 28 funds. And those funds, each of them has either their investment strategy, they have how they're thinking about investments and their return objectives. So it's really not a one size fits all. But I think I'd like to commend the NGX. When they were at the NSC, they did share the draft rules, and that's something that they've done, which is very good. Shared within our community, we went back and forth on a couple of things. So by and large, the rules, in a sense, sort of make sense to a large number of members of the community. And that needs to continue, the engagement between the NGX and the investor community. I think, like Eric V mentioned earlier, there's no point in bringing out a product or bringing out rules that don't meet the needs of the community. So flexibility needs to be there because things change, the market is dynamic. We need to be able to listen effectively, and we need to co-create. We need to co-create. That's something that it needs to come out there. It's not bringing a product and then coming months later to say, you guys need to invest. So I guess it's engaging the community, understanding their needs. In the end, the pension funds and the investment firms, all they want is risk-adjusted returns. Your pensions are there. You want them to invest with a sense of their fiduciary duty, and that is what we strive to do. So essentially, it's really a case of engagement, coming together, co-creating, listening, being flexible, and to be sure that the rules, the products meet the needs, ever-changing needs of the institutional investors.
Thanks a lot. I think I have Mr. Alassane CD back on the webinar. So Mr. CD, if you can hear me.
Yes, Yewande, I can hear you.
Okay, thank you very much. Would like to get the insights of the SEC. And I think one key question that has come up is that who exactly will be regulating SPACs? Now, the draft rules that the NGX has published is in relation to the listing, but we do know that the SEC is the key regulator for securities in Nigeria. And you had mentioned in your opening remarks that the SEC is working on some rules. So we would like to hear from you what, if you could share with us some insights into what the rules will touch on, and also the collaborative efforts that is being put in place, particularly as regards the FCCPC, the NGX, and yourselves, bearing in mind the need for speedy transaction timelines to be achieved in order to unlock this particular product and make it attractive to the investing community.
Thank you, Yewande. Let me start by saying that my sister, who happens to be our staff and continue to be our staff, even though she is on sabbatical to NGX, that notwithstanding, she has already is my work because she has already itemized things that are supposed to be looked into the rules. I can confirm, yes, we have received a submission from the NGX on their proposal, but we cannot do any clearance without us having a framework of which that we can give an approval for that particular rule. So on that note, the Commission has already made a draft of the rule, and the Rules Committee is already working honestly on it, looking at the demand from the NGX. So any moment from now, immediately we are done with the review, we are going to expose our rule to the market, and that will give us an insight of what comment that we are going to receive. And immediately that we finish that, we are going to pass that rule, and then we can now continue and keep a quick approval for the NGX. And that notwithstanding, we have not stopped reviewing the NGX submission. We are reviewing the submission of the NGX vis-a-vis making the rules as a framework that will allow us to give an approval for the NGX rule. But the major issue that we are supposed to know is that regulation of all public companies in Nigeria in terms of the Nigerian capital market is by the Securities and Exchange Commission as provided by the Investment and Securities Act. So first thing, SPACs are always PLCs. So the issue of approvals and other nitty-gritties in terms of review, yes, currently the Competition Commission is in charge of issues of mergers and acquisition, but whatever corresponding security that may arise from the SPAC must be registered with the SEC before it can be transacted on the floor of any exchange. So that's where we are coming first. And on the other side, one, as a commission, we have the responsibility of making a due diligence on this, on the sponsors, likewise the management of that particular SPAC, because we do have the responsibility of making sure so that whoever that is going to be an investor in the Nigerian capital market is fully protected. Two, we have to look at the minimum, in particular the bottom line of the total amount that is supposed to be invested in the SPAC, so that eventually we'll look at it, how could it help in terms of deepening the Nigerian capital market so that more people can be on board to say that they are interested in it. Because if you are able to come and have a bogus figure as a bottom line, yes, we can have the minimum, but the rest is left for whoever that wanted to be part and parcel to go up to whatever number that he can think it will be okay. So that eventually what we are after at this initial stage, being a new product in the market, is just for us to attract more people because the market needs a lot of liquidity for now. So based on the number of people that are on board, the more that we are going to get liquidity in the market, and the more that people will start having a better understanding. Now you can see, as I made in my speech on behalf of my commissioner, I made mention how the SPAC business is now getting acceptance in the US, and likewise globally, because I can hear from the other participant or the other moderator who was saying that globally he has a particular number of value that currently that has already been on board. So ours as a commission, we are more concerned about the development of the market and equally protection of the interests of the investors. And that's where we are going to look into our rules, and we are going to make sure that we give it a quick and possible passage so that eventually the rules of the exchange will be passed. And we are highly elated with the submission made by the exchange. We always look at them as a partner, and we know that whatever that they have brought is for the development of the market, and we'll make sure that it is going to be success. And we can assure you that we are going to give you all our support in this regard. Thank you.
Thank you very much, Mr. CD. That's very comforting. Ask very quickly.
Yeah.
Do we have any indicative timelines for when the exposure draft of the rules from the SEC will be published? Because I know that needs to be done before the NGX rules can be formalized.
I can assure you that it will be very soon, because we have significantly reached such a level for the review, and it's likely that it's somewhere around finalizing. Then immediately we have finalized that, we are going to expose it. And that could be in very, very, very near future.
That's very useful, because I'm sure a lot of people on this webinar are looking forward to being able to take advantage of this new product, and so eager to
we are actually not unaware of that, because privately people are calling to make an inquiry about how far we have gone about that. So we know, even you yourself, the pressure that you are getting from the other side. This is the way that we are getting the pressure. And I don't think that we'll do anything that will disappoint the NGX, because they are partners in these markets. Thank you.
Thank you very much, Mr. CD. So we look forward to the rules coming out soon. Back to Elizabeth. I think that, participants should please post their questions. I think we already had 2 questions from the last session that I would take as part of the question and answer session here. But just very quickly to Elizabeth, in terms of investor protection, you had mentioned that the funds will be ring-fenced and that the funds will be put into an escrow account. Are there specific provisions in terms of who the escrow agents can be? You didn't really touch on that, and how that ensures that the funds are kept independent of the sponsors of the SPAC.
Yes, thank you, Andy. So yes, the rule does have specific provisions on where the funds will be kept, and it requires that they are kept either in a bank or in a trustee or custodian that is regulated by the CBN or those that are registered with the SEC. The CBN is, of course, the apex regulator in the money market, and the SEC, the apex regulator in the capital market. And all capital market players are also expected to register with the SEC. So that provision is there to ensure that those monies are properly kept with recognized and registered operators in the market.
Thank you very much. That's helpful. Eric V, do you have any additional nuggets that you'd like to leave us with before I take on the few questions? I think there are a few questions in the Q&A box that I'd like to take before we wrap up.
No, I think everything has been said, for the most part. So I wouldn't want to take up too much time by repeating.
Okay, I think that, okay. Thank you. Oguchi, back to you, because as I mentioned before, you are key to the investment, a key player, a key stakeholder in relation to this product. Are there, apart from what has been said on this panel and what we have heard the first panel discuss in relation to key protections, the escrow provision, the ability to back out, knowing fully well that, in European markets, we had seen a bit of hesitancy on the part of sovereign wealth funds as well as pension funds in playing in the SPAC space because of the blank check nature of their businesses. Despite these protections that had been highlighted, do you still have any concerns or any areas where you would like the rules to cover? So for instance, Elizabeth has elaborately discussed the protections that the NGX rules would provide. Mr. Sidi has also talked about what the SEC rules will cover, and as well just ensured and try to comfort and assure that there will be clear rules in relation to governance, accountability, and investor protection. Is there any other thing that, as a key stakeholder, and bearing in mind your own critical objective of ensuring the safeguard of the funds under your custody, are there any other areas that you'd like the drafts of the rules to cover to ensure that your members are fully comfortable in investing and participating in these products when it's eventually rolled out?
Yeah, I think in the US that you referenced, there was a lot of exuberance, as you would expect. The numbers we've had, in 2020, the whole of 2020, there are about 250 SPACs. But in the first quarter of this year, 2021, about 300, just a little under 300 SPACs. So there was a lot of exuberance. And as you expect, as 300 SPACs are coming out in one quarter, there were some SPACs that were not either up to scratch. So some of the reluctance of those institutional investors were that, at some research that was done, about a large percentage of those stocks, about a third of those SPACs, about 90% of them return money back, because within the SPAC framework, you can, as an investor, decide not to invest, i.e. if there's a target that has been agreed upon and you don't want to invest, you can specify and they return your money back. So I guess there was a lot of back and forth regarding, okay, I put the money in the escrow, in the end it doesn't invest, then I do the next one, in the end they don't invest. So I guess with SPACs, like most investments, we back the rider and not the horse. So really it goes back to the directors, the sponsors, and the quality of the sponsors. So the NGX and the advisors on the call need to ensure that the kind of sponsors that come out have track record, the either operating or investments, and be sure that the deals that come out are up to a point whereby they can stand the test of time, to ensure that the regulations are the same for everyone, irrespective of who it is. There's no favoritism. So investors want to know that there's a level playing ground. It's consistently applied to everyone, and the goalpost doesn't change in the middle of the game. So I guess it's more about the thinking, the philosophy, and as a market, to be sure that this is a new product, that the first set of deals that we come out on SPACs are really top notch and get the investors excited. What we don't want is to have a first SPAC deal that doesn't do well, because we want to, sort of jump on the bandwagon that's happening around the globe, whereby, SPACs are an easier way for IPOs and for us as a community to help to deepen the level of investments that we can do. So it's something that we're behind, but we need to make sure that, the first set comes out and that there's consistency and that we back the right riders.
That's a very critical point that you have just made in relation to ensuring that, we don't just join the bandwagon, but make sure that there is viability in the first few SPACs that come on stream, particularly in a market such as this, that, even for M&A transactions, sometimes they're not able to, close because of certain issues that arise during the process. And you don't want a situation where the first few SPACs that come onto the market end up without being able to close a deal within the time frame. And that takes me back to the point of regulatory handshake, which is very important, because we do know that timelines for approvals will be critical to ensuring that, apart from the bilateral conversations between the sponsors and the target asset, there is also clarity as to the rules and the process for ensuring that the regulatory protocol to be followed does not hamper the ability of the sponsors to close their transaction within the 24-month period that has been stipulated under the rules. Thank you very much for that. Akil, I don't know if you have any closing remarks for us in relation to how SPACs, the trajectory of SPACs within the European market, and further to the amendments to the rules, whether there has been an improvement or what impact that has had in relation to the activities within the market.
Yeah, I think, kind of going back to Oguche's point, I think it's important to get it right. And, I think referring to the US, the amount of SPACs that, that has been seen, and some of the sentiment that has come out to do with the high level of redemptions hasn't necessarily helped over in Europe necessarily. There have been a steady flow of SPACs in Europe with respect to London itself. Since the new rules have come out, there hasn't been a SPAC as of yet under the new rules, but there is a positive pipeline ahead. I think the key kind of trends that we're seeing more broadly in Europe is that the timeline for acquisition is being shortened from 24 months to perhaps 18 months or 15 months. The other thing we're seeing is that the amount of capital that is being put in by sponsors and the amount that can be redeemed by the end investors is often higher than the typical $10 or 10 euros or 10 GBP that was initially offered to them at IPO. So there is a bit of overfunding that is occurring. So we're seeing structures change in kind of quite challenging times to raise capital to be able to ensure that a SPAC IPO gets off the ground. Now, I think that shouldn't compromise the kind of quality of sponsors that bring SPACs to market in all jurisdictions. And it shouldn't take away from ensuring that there are still relevant shareholder protections in place. So I think it will be an interesting space to follow, I guess, in the UK and Europe as the rules take a foot, and we can see more SPACs, but also how the NGX and the rules in Nigeria take hold. So it's a bit of an interesting space at the moment in Europe, but yeah, it's something that I think is not going to go away as well, because there are a lot of SPACs already present with a lot of dry powder, both in the US and in Europe. So they're looking for acquisitions. So it's not it's not a space which is going to go away, and it's, I think, going to continue to develop for the benefit of sponsors and shareholders.
Very useful point. Thank you. We have a question from Mr. Biliodum. Can SPACs be deployed as a vehicle for a management buyout? I think I would ask either Akil or Eric V to answer that very quickly, if you are able to do so.
Yeah, but just very quick, I think we sort of answered that with David's question in the earlier panel, the arm's length requirement, and then I think Eric I also suggested that private equity funds can in fact launch SPACs as a means of acquiring other companies in order to grow their own portfolio. By extension, I think the question speaks to whether a management team can use a SPAC as a way of targeting the company for which they are working and taking that company public. Again, as I mentioned, the rules as set up in the US, the arm's length, the requirement of identifying independent targets, going through the approbation process with investors, might be a difficult path, because of the lack of those key elements.
Thank you. I'm sure Mr. Odum has enough information in relation to his question. One last question I'll be taking before we wrap up our panel discussion. This is for Elizabeth, is from Mr. Olufemi Hassan, and he's asking in relation to the listing boards of the NGX. When Elizabeth spoke earlier, she mentioned the various requirements in terms of monetary terms for the premium board, the main board, and the growth board. The question is whether, apart from the monetary requirement, whether there are stipulations as to the types of investments in each category of the boards, and whether there are other restrictions that may apply to the various boards. And this is important, Elizabeth, because, you know, even in the SPAC's listing rules, it takes us back to the requirement for each of these listing boards. So it's a useful question. So if you can just explain whether there are other requirements apart from the capitalization requirements that you mentioned.
Yes, thank you, Yewande. The NGX listing rules are very explicit on what the requirements for listing on each board are. And with respect to SPAC, in terms of the minimum size, to be eligible for listing, you have to reach at least the minimum size of market cap that's required for listing on that board. And what we have said is for when there's a reverse merger, there's an acquisition and it's merging with a target, that target will also be reviewed and assessed on its eligibility for the board in which they are seeking to list. And so for the premium board, we expect that they will abide by the highest level of corporate governance. There's a CGS requirement that each company seeking to list on the premium board must achieve about 70% in that assessment. There's also a free float requirement, both in percentage and value. And for the main board, there are additional requirements in terms of profitability, shareholders fund, and free float as well. And for the growth board, just highlighted a few, for the standard segment, there's also a requirement of profitability or having a technical partner or a core investors, in this case, which the SPAC will be, who has met some of those requirements. And of course, there's the free float requirement, which you can meet in terms of percentage or on a value basis. Just highlighting a few more of these requirements as stated in the rules, which can be found on the NGX or the NGX website. Thank you.
Thank you very much, dear panelists. I know we have a couple more questions in the Q&A, which we may not be able to take. Just speaking broadly to two that I think I picked up in relation to governance as well as the capital requirements. I think Elizabeth had already expounded in relation to the governance requirements under the rules, and the draft rules have been shared in the chat box. So please feel free to read through and send your comments to the exchange if you have comments or queries in relation to the draft rules. In relation to the capital requirement, that has already also been covered. And just to add that the Nigerian laws in relation to foreign currency controls and regulation will still apply regardless of the nature of the product that is being considered. So whether SPACs or normal IPO, the rules in that regard remains the same. So thank you, Elizabeth, Akil, Oguche, and Eric V for your time. This has been quite insightful, of course. The time is never enough to discuss something as topical as this, and we know that there are other issues that will be agitating people's minds. I'm sure the NGX will keep the conversation going through other avenues, and we'll be happy to invite any of you to participate, and all the participants on the call can send through their comments to the NGX, and they'll be happy to respond to them. So I must say a big thank you to the NGX for the opportunity and for putting together such a very brilliant topic and panelists for this session. Thank you so much. And over to you, Toby.
Thank you very much, Yewande. Thank you once again, speakers, moderators, panelists, for the very insightful discussions. And especially thank you to our audience for the questions and the engagement. I'm afraid that's about all we have time for today. I will now hand over to Mr. Tony Ibeziako, the head of primary markets at NGX, to deliver the closing remarks and bring the session to a close. Thank you once again. Over to you, Tony. The floor is yours.
Good afternoon, everyone. On behalf of the executive management of the exchange, we want to thank our panelists, guests, participants for taking time out to participate in this maiden edition of the SPAC's webinar. We hope that this is one of the many avenues that NGX and the Securities and Exchange Commission will continue to bring innovative products that will drive market liquidity, market access, and promote products penetration into our markets. Thank you and enjoy the rest of your day.